Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Dearborn. He's the managing director on Nasdaq's market intelligence desk. Chris, great to have you with me as always. Again, the narrative back on rates rhetoric and, of course, the strength of the consumer, which is why we're seeing green across all the averages today.
You know, the earnings season ends relatively early, and then the consumer and retail names come out. And you've really seen a mixed bag there. You have significant winners and significant losers. But what you're seeing is that the consumer is still spending. The retail sales last week numbers show that we even popped on that. And you're seeing continued strength. And today we're seeing some of those winners. You saw some yesterday too, Home Depot, Lowe's, Target, absolutely. Last week was Walmart. And what you're looking at here is, where are people spending that money? But the good thing is for the GDP is that people are still spending that money, and that's going to flow right through to the bottom line. So really, you have low unemployment. We've talked about that for years and years and years. You've got wage growth, even though it could be a little bit higher. It's still pretty good, and that means people have money in their pocket. And with the rate cycle the way it is right now, we're waiting to see what happens out of Jackson Hole on Friday with the chairman's speech. But the minutes today came out with a mid-cycle tightening last July and the commentary back and forth gave the markets a little bit of a scare, added that volatility, which really isn't necessarily a bad thing. Nice volumes, opportunities, people who are capturing alpha, companies that are winning, and ones that need to kind of rethink their strategies so they can be put back into that winner's circle. And some of those companies that missed in the Q2, even though there was a low bar, have to rethink it, especially on the consumer side here. You're coming into back to school, which is relatively strong. We talked a little bit about that on Monday. And what you're looking forward to here is, the Christmas spend. And somewhere in between, those companies have to rethink that strategy. They have to check their inventory, and they have to become winners again.
It's so interesting going back to retail stocks to see Amazon, Walmart, and Target all performing well. It used to be Amazon versus the rest of the big box retailers. They seem to have caught up in their digital strategy.
There's been a differentiator of spread. So Walmart, which is considered, a food store, even though they're the world's largest retailer, just by what they sell and how much they sell of it, is still holding strong. Target's seeing a nice shift. The online shift has been a good change for them. Their omnipresence is really standing out for both of them. If you look at Home Depot and Lowe's, different types of retailers, but what you're looking at there is people are putting money back into their houses. They're spending there. Even though Home Depot missed on the top line, they reaffirmed guidance for the year, and it wasn't as bad as analysts feared. That's a quote from some of the analysts yesterday. It's not as bad as we thought it was going to be. Actually, it's not so bad. So if it's not so bad, that means it's good.
Then why do we need a rate cut? That's
right.
The next question.
So, yeah.
Yeah. Well, all right, let's pull up our first chart here. We have a 52-week on the S&P 500. A little bit of choppy action there. Might be a little bit unnerving for longer-term investors. Great opportunities for traders. Could also be good opportunities for longer-term investors. You're picking up some 401k shares at better prices.
Right. You're looking, this is still the 52-week chart. We've talked about this chart before. We have the moving averages on there, the 50, 100, and 200-day moving average. December sell-off, the significant rally for the first half of the year, a little bit of a June-ish sell-off, and then another big run to all-time highs here at the end of July. And then you've got the chop back and forth off of macro fears. Again, the tariff issues, trade talks, political uncertainty and going forward with the election coming up next year. What you have here is significant chop, high volume, true volatility. The difference is it institutional holders selling out of positions, or is it macro and day traders doing the chop? And what you're looking at here is opportunities for those who are paying attention in this August month to get some stocks at a discounted price to where they were at the highs. Now, moving forward, the chart looks pretty decent going here, and there's a retest of new high. If we can get through the 100 and 200-day moving averages, 150-day moving average, excuse me, there's going to be a retest of those highs. The question is, what macro headlines are coming out, and is there still an appetite for bonds, which kind of leads us to the next.
All right, yeah, let's take a look at the treasury yields over here.
Right, so Brian put this together today, and it's kind of interesting. So if you're looking at the red and top and the blue line is showing where we were last year into the December rate cut. And you see a normal sloping pattern on the 10-year yield, and it's showing a projected move. What has really happened since that point is the red line is the inversion of the 10-year. And if you look at the bottom, you're seeing how it compares it to the 1 month, 6 month, 2, 5, 7, 10, et cetera, up to the 30. And you talk about the inversion between the 2 and the 10, how the 10-year was yielding less, but it was only an intraday move. Is it a sign of recession? A lot of people like to harp on it. Not necessarily.
Right.
And I don't think so.
An intraday move is very different than a 3-6-9.
Right. It's always where does the stock close? Where does the yield close? Where does it settle? And yes, there are fears out there. Germany sold 30-year boons today. It came in less than they thought. They didn't get as much demand at negative 0.11%. You got to pay the money. You know, they only raised about half the money they were hoping to get. So the appetite for corporate debt is for governmental debt is still there because by mandate for a lot of people, but people are starting to take a step back and take a look at what's going on. This curve needs to straighten itself out for people to have a more normalized feel, and this is kind of putting that picture there, what it should look like moving forward. If it normalizes, we're definitely going to get a cut in September. Depending on what he says on Friday, we'll set that stage for where the markets are going to go and the appetite for that debt. If people are rolling over out of equities, then you're going to see a massive sell-off on the S&P, and you're going to see the inversion continue. If people are still mixed like they have been on the volatility, you're going to see people putting money to work in all different pies. Gold's a good example, still trading at $1,500 an ounce. You know, unsure. Investors don't like uncertainty. This inversion and the curve we're looking at here is uncertainty. The S&P right now is in a period of flux, uncertainty, and what you need is guidance. And guidance is either going to come out of Washington, out of Beijing, or it's going to come out of Jackson Hole. And it's only going to be as good until the next headline.
Well, it's also only going to be as good until the next election. There's going to be a lot of uncertainty up until then. Trump needs this economy to keep going full tilt. He needs the market to stay here. He needs to get his rate cut. So it's going to be a lot of headlines back and forth in terms of what he thinks he needs and in terms of what the market is saying.
Pompeo had a great comment yesterday saying, yes, he does think that China and the U.S. will get a trade deal done. However, it may not be to the 2020 election if China keeps a wait-and-see approach.
Yep, they're going to have to kick it down. They're going to have to kick it down the lane at least until November.
So that leaves a lot of uncertainty, a lot of macro fear. If you're a longer-term investor, you know, is the buy the dip crowd still out there? Yeah, they are.
Sounds good, Chris. Thanks so much, as always. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.